All right, let's just cut straight through all the noise. You've probably heard a million different things about investing, seen all the gurus online promising you the world. We're not doing any of that. This is a blunt, no-nonsense guide for your first investment, based on some pretty tough advice. So let's start with the one question that really matters, and you need to be honest with yourself here. When you put your hard-earned money into the market, what are you actually trying to do? Are you patiently building real long-term wealth, or are you just at the casino, gambling? How you answer that question changes everything. You see, there are really only two ways to go. On one side, you have the long-term investor. They're focused on the process, on time, on consistency. And on the other side, you've got the short-term gambler, always chasing that next hot tip, that quick adrenaline-fueled win. One of these paths builds a real fortune, and the other one, well, it usually ends in disaster. Let's talk about that path first. Okay, let's talk about the shiny, exciting path that pulls in so many new people, the high-risk gamble. It looks amazing on social media, right? It promises fast money, big wins. But the truth is, for almost everyone who tries it, it is a game that you are basically designed to lose. And here is the harsh truth, straight up. If you're starting out with a small amount of money, then getting into things like day trading or using really complex tools like futures and options, it's just not a good idea. Think of F&O as just placing a bet on where a stock's price will be in the future. It's incredibly risky, and for most people, it's a surefire way to lose your money. And you know who gets burned the worst by this stuff? It's often the people who can least afford it. We're talking about students using what little money they have, salaried workers who definitely don't have time to be glued to a screen all day, and, heads of families who have real financial responsibilities. This kind of high-stakes game doesn't just demand money. It demands all of your time and attention, and the risk is just devastating. And let me be perfectly clear about what's at stake here. We're not just talking about losing a bit of money and feeling bad about it. The real risk, the end game for this kind of gambling, isn't just losing your initial investment. It's going completely broke. It's bankruptcy. It's that serious. So if that's the path to ruin, what's the right way to do it? Well, I'm going to be honest. The real path to wealth, it's actually kind of boring. But boring is where the real power is. Let me show you what I mean. Look, the data here really tells the entire story. Just look at these 10-year growth rates. Your quote-unquote safe fixed deposits, they barely even keep your head above water. Gold does a little better, sure, but then you look at the market index. Over the long run, it has historically crushed everything else. The numbers just don't lie. So what about those safe fixed deposits? The source actually calls them a cash-burning scheme. Why? Well, think about it. You might earn a few percent in interest, but the actual cost of your life, your food, your rent, your gas, what we call personal inflation, that can be going up by as much as 9%. So every single day your money sits there, it's actually buying you less and less. You're losing money in slow motion. So how does the market do it? How does it deliver these incredible returns? It's not some kind of secret trick or a complicated scheme. It is the simple, beautiful, undeniable power of compounding. It's not magic. It's just math. And it's fueled by the one thing that every single one of us has on our side: time. Okay, so let's break down how this compounding math actually works. Imagine you start investing. That first significant chunk of profit, let's just call it X, it might take you a full 10 years to earn. A whole decade. And believe me, at the beginning, it feels painfully slow. But you gotta stick with it, because this is where it gets good. To earn that exact same amount of money again, that next X, it doesn't take another 10 years. No way. It only takes 5. Your money is already working for you twice as fast. And it just keeps getting faster. To earn that next X, it only takes 2.5 years. Do you see what's happening? That's the snowball effect. That is the incredible power of compounding. The longer you stay in the game, the faster and harder your money works for you. So what's the big lesson here? It's this. Consistency is what creates wealth. Not trying to be a genius, not trying to time the market. It's about staying invested, especially when things get scary. When there's a crisis and markets are dropping, the gambler panics and sells everything at a huge loss. The investor? They stay calm. They trust the process. They just stay the course. Okay, so that's all the theory. Now, let's get practical. Let's turn all of this talk into a simple, actionable blueprint that you can actually start using right now. This is your 10-year plan. But before you put a single dollar into a growth investment, you have to avoid this one massive mistake. Do not treat your investment account like a piggy bank. Your long-term funds are for building wealth, period. They are not for a sudden car repair or an unexpected bill. Every time you pull money out, you kill that compounding magic we just talked about. So here's the proper order of operations. Step 1. Build an emergency fund. This is cash, kept in a totally separate, safe, easy-to-access account. Step 2. Get yourself proper insurance coverage to protect you from a real disaster. Only then, once those two things are solid, do you move to step 3, start a systematic investment plan or an SIP. It just means you invest a fixed amount automatically every single month. You have to build a foundation before you can build a skyscraper. And look, you do not need to be a millionaire to get started. The advice here is super clear. Starting a simple, consistent plan, maybe $5,000 or $10,000 a month into a basic market index fund and sticking with it for 10 years is an infinitely better, smarter strategy than taking that same money and just gambling it away on high-risk trades that you don't have the time or the capital to manage properly. So we end right back where we started, with a choice. You have two paths in front of you. The path of the gambler offers a quick thrill, but it almost always ends in failure. The path of the investor, it takes patience, it takes consistency, but it is a proven blueprint for building real, lasting wealth. So the question is, 10 years from now, when you look back at the decisions you're making today, which version of yourself are you going to be thinking? The gambler or the investor?